Welcome back to Fault Line Finance. Think about the most consequential financial policy of the last decade. Not a central bank rate decision, not a trade war tariff, not a temporary liquidity injection engineered by the Federal Reserve to mask structural decay. I'm talking about a single bureaucratic memo that went live on April 1st, 2026. The Western financial press completely ignored it. They read the date, assumed it was a meaningless developing nation policy experiment with zero impact on the global monetary order, and they moved on. They were catastrophically wrong. Right now, silver is trading at $75.45. Gold is at $4,679. But beneath these numbers, a physical drain is tearing through the market surface, a quiet revolution that the pricing algorithms have not yet processed. The Global South is quietly withdrawing from the dollar-based financial architecture. We are witnessing the shadow integration of the global economy, a return to hard assets, and a deliberate discarding of dead paper instruments denominated in currencies they do not control. What you are watching is not a market anomaly, it is the calculated dismantling of the fiat illusion. For decades, the West has weaponized its currency, freezing reserves and locking sovereign nations out of the settlement network. That weaponization taught the rest of the world a brutal lesson. If you do not hold the physical element, you do not hold the wealth. What started as a whisper among central bankers has now been codified into law. The remonetization of silver has begun, starting in the most silver-intensive culture on Earth. The window between when a sovereign policy is enacted and when the global pricing mechanism catches up is precisely where the most transformative wealth transfers in human history occur. The price you see today is the last cheap silver you will witness in your lifetime. On April 1st, 2026, the Reserve Bank of India activated a historic monetary framework that permanently fundamentally alters the definition of Tier 1 capital. Every bank and every non-banking financial company in India, the very institutions that serve tens of millions of citizens operating outside formal commercial banking, are now legally authorized to accept physical silver as collateral for cash loans. Let me be precise about what qualifies, because the central bank was completely ruthless in its distinction. The eligible collateral includes physical silver jewelry, silver ornaments, and silver coins. The excluded collateral is a direct attack on Western financial engineering. Silver bars are out. Silver exchange traded funds are out. Paper silver that exists merely as a digital entry in a clearinghouse does not qualify. The Reserve Bank of India looked at the entire spectrum of financialized silver products and drew a bright legal line between the atomic reality of the element and the fragile promise of paper. Only the element qualifies. The mechanics are elegantly clean. A borrower can pledge up to 10 kilograms of silver. The lender can extend a loan worth up to 85% of the current market value of that metal. The borrower retains ultimate ownership, while the silver sits locked in the lender's vault. When the loan is repaid, the metal returns. If it is not repaid, the lender holds an asset anchored in the laws of physics, not in the confidence of a highly leveraged counterparty chain. This policy reclassifies silver from a mere industrial commodity, elevating it back to a recognized foundation for credit creation. The old monetary system died in 1971, but its successor was just planted quietly in the East. To understand why this single document will break the global supply chain, you must understand silver as a lived cultural reality for more than 1 billion people. India does not hold its wealth entirely in institutional vaults. It holds it in steel lockboxes under floorboards, in jewelry cases in Mumbai apartments, and in the hands of farming families who have accumulated the metal over generations. Silver is their pension fund. It is their crisis insurance. It is a tangible manifestation of security embedded deeply into their collective unconscious. But the old system laid a brutal trap. When a medical emergency arrived, or a harvest failed, there was no mechanism to generate liquidity without surrendering the asset completely. Families were forced to sell their ancestral security to dealers at spot price, receiving depreciating paper rupees in return. That generational wealth walked out the door, into the smelting pot, and fed the global industrial supply chain with a fresh injection of cheap, refined scrap. It was an elegant, cruel extraction mechanism that stripped hard assets from the vulnerable to feed the industrial engines of the West. The new Indian framework turns that extraction system off permanently. The moment a family can pledge their metal for liquidity without surrendering ownership, the incentive to sell collapses entirely. The secondary scrap supply does not just decline, it falls off a cliff. This reflects a truth encoded into human language itself. In dozens of civilizations, the word for money and the word for silver are completely identical. In Mandarin Chinese, the word for bank literally translates to silver house. The financial engineering of the 20th century tried to overwrite this psychological archetype with fiat currency. Now, a nation of over 1 billion people is allowing its banking system to remember what its language never forgot. While the monetary argument is being codified in banking law, the industrial reality is simultaneously crashing into a rapidly shrinking pool of available physical supply. The convergence of these two massive demand streams is the core of the impending crisis. Solar panels require highly refined silver paste to create the conductive pathways that convert light into electricity. Electric vehicles carry vastly more silver content than internal combustion engines. Medical sterilization systems, advanced military guidance platforms, and hyperscale computing all depend on the element's unparalleled thermal and electrical conductivity. There is no functionally comparable substitute at scale. None of these applications are discretionary. When a manufacturer needs silver to keep an assembly line moving, they cannot use a futures contract or a digital entry at the London Bullion Market Association. They require physical bars. For years, these industrial giants built their profit models around artificially cheap silver, relying on the steady river of recycled scrap flowing out of the East. That world ended in April. The river of scrap is drying up, and industrial consumers are suddenly finding themselves bidding against sovereign monetary architectures. The data is already screaming. In March of 2026, China's physical silver imports surged to the highest level ever recorded in a single month. 836 tons. 836 tons of physical metal crossed the border in 31 days. Concurrently, sovereign wealth funds in the Middle East are quietly bypassing the Western exchange infrastructure entirely. They are going straight to the mining companies, securing the raw supply before it ever enters the global distribution chain. They are expressing, through billions of dollars in purchasing behavior, a total lack of confidence in the paper market's ability to deliver. Let us examine the mathematics of this paradigm shift with absolute clarity. With silver at $75.45 and gold at $4,679, we have a gold to silver ratio of approximately 62 to 1. It requires 62 ounces of silver to purchase a single ounce of gold. Hold that number against the span of recorded economic history. During the Roman Empire, the medieval monetary systems, and the bimetallic standards that governed the 19th century, that ratio consistently averaged between 15 to 1 and 20 to 1. The metals were priced relative to each other based on their actual scarcity and utility. The current ratio of 62 to 1 was only defensible in a temporary distorted reality where silver was demoted to a mere industrial input while gold retained its crown. But the sovereign policies of the East have just officially readmitted silver back into the highest tier of the global monetary order. A recognized monetary collateral asset is not priced like an industrial consumable. The algorithmic trading desks in New York have not yet modeled the permanent sequestration of household wealth into regulated bank vaults. The market is still operating with a blind worldview, pretending the secondary supply chain is intact. This massive disconnect between what the paper market believes and what is already operationally true on the ground in Asia is where the opportunity lives. The supply shock will not arrive with a bold headline in the mainstream press. It arrives incrementally, loan by loan, vault door by vault door, until the physical exchanges discover the metal they assumed was available for delivery has permanently vanished. The transition is accelerating. The mathematical repricing is a certainty of physics, not a prediction. The paper illusion is breaking. Hold the element. Let me map the trajectory of where this ends, because India is not the conclusion of this story. India is merely the opening move. When China officially announces its remonetization framework, the logic propagates through every single nation that shares three defining characteristics: a deep cultural memory of silver as real money, an existing stockpile of privately held metal, and a strategic, existential necessity to reduce their exposure to the United States dollar. Look at the geography of this defiance. Look at Southeast Asia, where the memory of catastrophic currency crises is still fresh. Look at Latin America, where the trauma of dollarization and currency collapse is the lived experience of grandparents who are still breathing. But most importantly, look at what the United States did in 2022. When Washington froze $300 billion in Russian foreign reserves overnight, it weaponized the reserve currency. And that weapon taught the entire developing world exactly why they desperately needed a monetary system that the West could not switch off. Every sovereign nation watched that confiscation. Every central bank realized their paper reserves were merely unsecured liabilities. They now have a working template to build a foundation entirely outside the jurisdiction of Western settlement systems. Silver, held physically, vaulted domestically, and used as the foundation for domestic credit, is outside the SWIFT network. It cannot be sanctioned, it cannot be frozen, it cannot be deleted. India provided the legal blueprint, China will provide the massive industrial scale, the rest of the global south will provide the momentum. This is the architectural replacement of one global monetary system with another. I know what the mainstream counterargument is, because the financial media is already building the narrative to keep you sedated. They will point to this week's coordinated central bank meetings. The Federal Reserve, the European Central Bank, the Bank of Japan, and the Bank of England all are evaluating rate decisions simultaneously. The media will call their collective inaction a sign of resilience. They say the system is managing perfectly. Here's the brutal truth they refuse to broadcast. The central banks sitting on their hands right now are not doing so because the economy is healthy. They are paralyzed because they have absolutely no mathematical options left. The global money supply, the total volume of fiat currency actively circulating in the system, is at unprecedented record highs. The money printing that began in 2008 never actually stopped. It simply accelerated into the shadows. The M2 money supply is compounding at rates that have absolutely no historical precedent outside of wartime financing. Institutions responsible for price stability look at supply chain disruptions and geopolitical shocks and call them the source of inflation. They are lying. They are managing the public's perception of inflation rather than fighting it. Fighting inflation requires removing liquidity. Managing perception requires pointing the finger at anything other than the central bank itself. Meanwhile, the petrodollar arrangement, the foundation of global demand since 1971, is under sustained lethal pressure. The alternative is not a new digital currency. It is physical gold and physical silver. This brings me to the most operationally critical distinction I can possibly offer you today. Everything we have analyzed, the Indian remonetization framework, the massive Chinese import surge, the aggressive sovereign wealth fund behavior, the draining exchange inventories, resolves to a single terrifying practical question. Are you holding the thing itself, or are you holding a vulnerable paper claim on the thing? The Reserve Bank of India answered this question in the clearest possible regulatory language. They explicitly excluded silver exchange traded fund products. The institution that just reclassified silver as a Tier 1 monetary asset looked directly at the entire paper silver universe and declared that none of those instruments qualify as actual collateral. Think about the mechanical reality of a silver exchange traded fund. You hold a derivative claim on silver that is supposedly held by a custodian in a complex system governed by rules set by a captured exchange, regulated by an authority that can rewrite those rules on a weekend. You are entirely dependent on a counterparty chain that runs from your retail brokerage through a massive clearing bank to the vaulting custodian and back again. Every single link in that chain is a catastrophic point of failure. Broker insolvency, custodian stress, exchange suspensions, regulatory freezes. Any single break in that fragile chain instantly converts your performing financial asset into a worthless, uncollectible legal claim. Physical silver has none of these vulnerabilities. When you hold the atomic element in your hand, its value is not contingent on any financial institution remaining solvent. Let me bring this entire thesis back to exactly where we stand at this very second. Silver is trading at $75.45. Gold is at $4,679. And beneath these flashing numbers, a physical reality is unfolding that the market algorithms have completely failed to process. The Reserve Bank of India's policy is fully live. The loans are actively being made. The bank vaults are aggressively absorbing physical silver that will never ever return to the open market. China imported 836 tons in a single month. The sovereign wealth funds of the Middle East are bypassing the exchanges entirely to secure the raw element. The paper price simply does not know this yet. It is still living in a pre-April 1st delusion. The gap between where the price currently sits and where the geopolitical policy has already moved is the final window of opportunity. It is the exact same window that existed in every previous major monetary transition in human history. And these windows do not close with a gentle, gradual drift. They close with a violent, structural repricing. You do not have the luxury of waiting for the Western financial press to validate this thesis for you. By the time they finally print the headline, the arbitrage will be entirely gone. The physical dealers will have sold out signs hanging in their windows. The cascade is building right now. The price will inevitably catch up to the policy. That is not a financial prediction. It is an absolute certainty of physics. If the veil has been lifted for you today, you know exactly what you need to do next. Hit the like button to force the algorithm to push this reality to those still trapped inside the fiat illusion. Share this masterclass with the one person in your inner circle who possesses the psychological architecture to handle the truth. And if you are fully committed to tracking the shadow mechanics of the financial system, subscribe to the channel right now. The window of opportunity is violently closing. Stay awake, acquire the element, and I will see you in the next transmission.